Welcome to the Keiser Report. I'm Max Keiser. Spankings are trading at an all-time high. According to The Economist magazine, bankers are paying top dollar, or pounds in this case, for a good old-fashioned bottom slapping from a dominatrix. Who can show them who is the true bad boy? Meanwhile, because of the debts and the austerity pushed by these same masochistic spanking-loving banksters, The Economist magazine reports that the prostitution market in the UK has been flooded with new entrants, driving prices ever lower. Me love you so long time for these discount brokers of love in the alleyway. Stacy?
Yes, Max. So bankster bashing is doing very well, despite what David Cameron tells a population not to bash the banksters so much. But according to The Economist, sex doesn't sell. An old industry is in deep recession. Times are tough for Debbie, a prostitute in Western England who runs a private flat with other, quote, mature ladies. She does 2 or 3 jobs a day. A year ago, she was doing 8 or 9. She has cut her prices. Quote, if I hadn't, I wouldn't still be open. She says that she can now make more money doing up furniture and attending car boot sales than she can turning tricks.
Yeah, I think this is fascinating because the government and people like Vince Cable and others are saying that we should stop the banker bashing. It's unfair to the banksters to publicly pillory them. And yet these guys are going to dominatrix to get beat up, to get spanked, to get punched in the face by professional dominatrix. So they clearly want to get beat up. They clearly want to be treated and degraded, treated poorly and degraded. So I think that the government, in order to save a bundle, should hire some dominatrix on the payroll of Her Majesty's government. Their sole purpose should be to go down to the city every day and beat these banksters up bloody and save the taxpayer a lot of money. They love it. They're dying to be beaten up. They're crying out for it. The prices are skyrocketing. Why can't the government capture that spread? Why can't the government cash in? And the banksters need to be degraded and treated poorly by professional dominatrix.
Well, also, you can compare the problem for the prostitutes here in the UK with what's going on in the market, because the fact is, The Economist points out that there's a flood of new entrants because of the bad economy, because of declining wages, but also because of all the debts pushed on the students. There are a lot of young people entering the market in order to pay their student debts. And the Economist points out that these new, more naive, innocent entrants to the market are putting themselves at huge risk for very little reward. And you see that almost everywhere in our economy, people are taking huge risks for very little rewards at this point.
Yeah, well, I see your point there is that with interest rates being forced down to zero, people are taking huge risks by going into stocks at all-time highs, by going into the bond market at all-time highs. Meanwhile, the government is manipulating the price of gold lower so that people shy away from gold. But the point is that austerity measures imposed by George Osborne is a pimp because he brought in austerity measures that drove down the wages and jobs in this country to the point where now millions of young British teens have had to turn themselves into prostitutes to make ends meet. So George Osborne is the biggest pimp in the history of Britain.
Well, one other thing I'll say on this before moving on to the next is that here we have a situation where this mature woman is saying that she can make more money now, not turning tricks, but actually working, doing something for a living. And maybe that's the one upside of a disastrous, collapsed economy, is that people might actually say, oh, instead of playing Farmville all day or flipping houses, I might actually have to get a job because I can make more money doing that.
Right. Osborne's a pimp for the real estate industry and for these young teens that are forced into prostitution because of austerity budgets. He should get like a big purple furry hat and maybe a pink Cadillac and drive around Westminster like that. I'm George Osborne, the mofo pimp. I'm the Mac Daddy of the Bank of England. Come into my ride and I'll show you a good time. I'm George Osborne, the pimp.
Well, the mature lady right now on the global fiat currency system is the dollar, and there's no love for the dollar these days, but there's enduring love. Do you like this segue into the next headline?
This dollar needs a prophylactic to keep it from spreading its deadly financial semen throughout the global economy, impregnating various governments with uncontrolled and called for progeny of incipient inflationary crack babies.
Well, Frank Holmes writes of the enduring love for physical gold. The love trade for gold is still on. So he looks at the breakdown of the global gold demand from the World Gold Council through March 31st, 2013, and the main source of weakness was the fear trade, as demand for gold ETFs and similar gold products plunged in the first quarter. However, the love trade scooped up jewelry and bars and coins, with the tonnage in each category growing 12 and 10% respectively on a year-over-year basis. It was in India where we saw gold demand grow by 27%. In the U.S., it actually grew by 22%, and in China, it was up 20%. He calls this the physical gold market is the love trade. The ETF is the fear trade.
Yeah, it's amazing that when the government's actively engaged, along with J.P. Morgan and others, in manipulation of gold and silver, it causes fear in the hearts of speculators and house flippers in the West. But the feeling enjoyed by the East is love. They love to see those low prices in India and China and Vietnam. They go out and they buy physical gold. They love it. And I say, keep doing it, Vietnamese people, Chinese people, Japanese people. Gold loves you. You love gold. It's beautiful.
Well, in fact, what he's saying is that people were investing in the gold ETF because they feared government policy, they feared inflation, they feared deflation, they feared what was happening in the economy. But now he's suggesting that Westerners, those in America holding gold, GLD, the ETF, no longer have fear. They feel that they believe the propaganda now. They've capitulated. They say, okay, we trust Ben Bernanke that he's going to rescue the economy.
Well, that's again, this is the classic syndrome that happens when it's called grooming. Ben Bernanke has groomed the American population into believing that he loves them before he pimps them out like George Osborne does. They're in for a whole heap of trouble. Meanwhile, people in Asia are saying, we don't want them Ben Bernanke, George Osborne, pimp daddy nonsense. We're just going to buy physical gold, and you can take your paper fiat nonsense, dollars and pounds, and it can disappear.
Well, other than that story was focusing on the consumer level, the individual level, then the next story looks at the global geopolitics of gold, and in fact it's called The Geopolitics of Gold, and it's from Gold Money, and it was written by a former guest here, Alistair McLeod, and he's looking at the fact that the Shanghai Cooperation Organization, that region, has basically cornered the gold market, them and India, and because of this, the result is that gold markets are now failing to clear. The outcome is a choice. The West will either have to stop intervening and allow gold to find a level where physical and derivative markets interact properly with each other, or capital markets in the West will face a growing crisis likely to spill over into other markets. While these outcomes were always going to be a choice to be made at some time in the future, the disconnection between physical gold and derivatives has become so great that it is now an immediate concern.
Fail to clear. Those are words that are really exciting to see and hear, because it means that this market's in complete disarray. So, in other words, when people show up to buy or sell gold, there's not an offsetting trade to clear the price. And what's happening is that the gold bullion banks, the banks in the UK and in the US, they're borrowing gold from the central banks to make good on physical delivery, which means that the gold in Fort Knox has been hypothecated. It means the gold the Bank of England has control over has been hypothecated and then rehypothecated, as to say that it's been loaned out to be sold into this marketplace. So when the price finally breaks free of the shackles of manipulation, you see a $10,000 price on gold, which is, I say, there's a 99% possibility of that happening in the next 36 months. These central banks are going to have to declare bankruptcy. So gold will keep going higher, silver will keep going higher, and of course Bitcoin will then break out and head toward much higher levels.
Well, he's suggesting it's the clash of the gold titans, because the fact is that China, Russia, and these other countries in the region, including Turkey and India, they know that the Western Central Bank gold vaults are empty. So now they're just playing a game. It's a grand game of geopolitics, of chess. And they know that this is going to be, well, what happens in any market when you know somebody is short in a great mass, you can force a short squeeze. You can force somebody, you play the players. And this is what we're seeing on a geopolitical level.
Right. We saw it recently with Carl Icahn, knew that there was a huge short position in Herbalife, which is a Ponzi scheme listed on the New York Stock Exchange. And he went in there and he bought up a lot of the stock, took it off the market, and the other hedge fund guy, Ackerman, who was short those shares, is in deep trouble. He kept getting margin calls and more margin calls. So imagine Carl Icahn is in charge of Russia, China, and Iran and these other countries' gold buying policies, and you can start to see the problem that the West has going forward.
Well, of course, in the West, everybody's terrified of prices. They follow price signals, and that's it. Whereas in the rest of the world, they're chasing ounces, they're accumulating ounces, and in the case of central banks, tonnage. And finally, SocGen's Albert Edwards is also saying the same thing. Warning, stocks to crash, gold to top $10,000, Albert Edwards. In a note that he wrote recently, Edwards said that central bank stimulus measures will drive the world towards global recession, soaring inflation, and a Japanese-style loss of confidence in policymakers. Quote, we may have seen the peak of nominal U.S. GDP growth for this cycle. An unfolding recession should see a 10-year bond yields dragged ever lower and the Fed moving to QE infinity squared, he said.
QE infinity squared? That's a lot of QE. But I think it's important for people to understand that when these central banks are flooding the market with more credit, remember all money is credit-based. There's no actual money in terms of it being sound because we went off the gold standard or any tie to the gold standard back in the early 1970s. So when they flood the market with more of this credit, what they do is they don't actually extinguish debt. They're not actually solving the debt problem. They're giving more pseudo-collateral to various banks to expand their balance sheets exponentially. This is why you have this term QE squared, which sounds quite remarkable, something Einstein might come up with when he's trying to figure out while traveling on a beam of quantitative easing what the world looks like from several 100 million light years away. It would look like an enormous fiat currency bubble bursting is what it would look like. And it's important for people to understand that this money printing is not to somehow solve the problem. It's to throw gasoline on the problem, because for every dollar of credit that these banks create, another 1,000 is engendered into existence through the so-called derivatives market, where it's now $700 trillion. Very important last week, Stacy, a court in America decided that the $700 trillion derivatives market did not have to be regulated at all, because there was a question that suddenly, per some regulatory statutes on the books, that they would have to start reining in their derivatives trading, which is now $700 trillion, or 15 times greater than the GDP of the globe. But that's now been eliminated, so they're just making the problem a lot worse.
Well, to tie it to the top, the money is being given away. They're the equivalent of the prostitutes, the overpopulation of prostitutes here that are giving it away, whereas gold is what Albert Edwards says is the one that's going to give the world a spanking, these derivative wielders giving away their free stuff.
Spanky, spanky. Stacy, thanks so much for being on the Keiser Report.
Thank you, Max.
Stay tuned for the second half. I'll be speaking to Mitch Firestein.
A clear image of Iraq after invasion. 20-day taxi trip through the country. The road full of danger. Clear evidence from north to south. The route map of Iraqi tragedy. After the war, waiting for peace. Baghdad Taxi on RT.
Choose your language.
Good morning from me, Kevin Owen. Bienvenidos a nuestra edición semanal.
Choose the news that concerns you. Choose the opinions that invigorate your mind. Choose the stories that impact your life. Choose the access to your RT.
Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Mitch Firestein, author of Planet Ponzi and the website planetponzi.com. Here's the book, Planet Ponzi, now in paperback. It makes an excellent gift. Mitch, welcome back to the Keiser Report.
Thanks for having me back, Max. It's great to be here.
All right, first question. You are the chart man. You bring charts. Today's charts is the VIX, the VIX futures. Tell us, what is the VIX and why are we looking at this?
Well, I think what we need to talk about is credit risk overall globally and what's been going on with the central banking policy. The central banks would like to promise to you, they've built a lot of castles at low tide, and the tide's about to come in. The VIX is the volatility index in the U.S. stock market, and for some reason, as the volatility has gone down mysteriously from 2009, the volume of these contracts has gone from about 4,500 per day to 95,000 per day, which is an increase of about 2,000. So now, I was under the impression that Sarbanes-Oxley, Dodd-Frank, and all of these regulations that were put in place, besides the ones that were recently authored by Citibank, I think, or the other banking institutions, were to cut down and minimize on risk. So I don't know who's taking the speculative positions on the VIX or why volatility has come down, but if I were working for one of these regulatory agencies, I'd certainly be looking into that. Credit risk has been totally perverted now. You have high yield, which is triple C credit, trading below 5%, which is hardly realistic because the probability of a default is still extremely high for these corporations. So there's too much money chasing high yield.
Right, that 5% number that we see on the junk market is where the U.S. Treasury body was only maybe 6 or 7 years ago.
Correct. And 7 months ago, you had the 10-year trading at around 1.40. It's a little over 2% now. So Triple C is as bad as it gets, but I think what you have now is a coordinated central bank policy of triple D, which is divert, deflect, and deceive. So basically what they're doing is selling to the public that this quantitative easing is going to work. And I think that it's going to turn out to be extremely problematic. We spoke about Japan and what was going on in Japan.
Hold on. We want to focus on VIX for a second because the VIX, the VIX, this is kind of like a barometer of what traders think is going to develop in terms of volatility. VIX, the V for VIX is volatility. And so it's a way for to monitor, if you will, the health of the market. Now, if you're saying that the volume in the VIX contracts has increased by 2,000%, and yet the price of the VIX is actually down or trading near its lows, doesn't that suggest, Mitch Firestein, that just like gold and silver, there's a coordinated effort to keep that price from telegraphing volatility, from telegraphing nervousness, anything to get people thinking twice about stocks? They're going to keep those things kind of muffled and down. Your thoughts?
You're right. The volatility index is what it stands for, and it was created, I think, in 1993. And if you push that price down artificially, or somebody pushes that price down, the way that it's hedged is by coming in and buying the outright S&P 500. So people are going to buy stocks against it. So it's going to push people into the stock market and make stock prices go higher. If we look at what's been going on in the stock market since 1981, I mean, we've had an incredibly bull market. I think it's an increase of 1,940% or something like that. 2007 through 2009 saw record spikes in volatility. We had big ups and big downs and big ups and big downs. Now that's been neutralized. So what my point here is, well, why is there a 2,000% increase? Because the margin on each one of these contracts is so enormous that it's got to be a much bigger to fail institution, or way too big to fail.
Okay, you're a hedge fund manager. So during those huge spikes in the markets, did the VIX show any correlation? As I recall, the correlation was not too good at all. That people were saying, well, there's a huge spike, but look at the VIX. If there was generally some systemic problem, we would see it trade higher, right?
Well, there were spikes, but they did not last at all, and there was a big seller. There were always big sellers that came in towards the close. Every day there's a coordinated effort to push the price down. So whenever you had a spike in volatility, you'd have a 2 or 3 day spike. Somebody would come in and bang it. It was a slam down.
All right, so is the price signal from the VIX any good? Just like is the price signal from the bond market or the stock market or the credit default swap market or the energy market that are all been proven to be completely manipulated manipulated? Are we getting price signals that are accurate from any of these markets?
I think this is the problem, and you've hit the nail right on the head again, is that the price markets are totally distorted. So you've got risk trading, and my example was the CCC credits are trading, the junk bonds are trading below 5%. It should never be there, which means you're going to have a catastrophic wave of defaults. You will have sovereign defaults as well. And that's, the end game that people want to try to avoid, and that's why they're pumping so much liquidity into the markets. $85 billion a month the Fed is pumping into the markets with a hope that things will get better soon, and they haven't gotten better soon. All that's happened, or stock prices have gone artificially higher. I mean, if you look back into the Japanese stock market, the Nikkei, in 1989, the Nikkei traded around 38,952 or something. And in the 20-year cycle to 2009, it dropped to something like 7,500 and change. That was a drop of 82% in 20 years. Corresponding, the Dow has gone the other way. So, the Dow still has room to run to the upside, but how much can a bubble inflate? It depends who has the bullets. A Ponzi scheme, which is what this is, it's a massive Ponzi scheme, and I explain it in detail in the book, is, you replace the old dummies with new dummies. And as long as you have money flowing in, then it's going to go well. If you have a printing press, even better, until you get a bond market repudiation, which is what is going to happen. Eventually, people are going to say, like in Japan, okay, enough is enough. I don't want the Japanese bonds. I've lost 30%, and we've discussed this before. I've lost 30% on my currency with these bonds, and now the yield is going up, so the price is going lower. So I'm losing two ways on this trade. It's a terrible trade.
All right, so bond market repudiation. Another phrase would be bond market vigilante. There used to be, under Clinton's days, remember he said, I want to come back as the bond market because the bond market has all the power. Bond market under Robert Rubin, when he was trying to get Clinton to walk away from reforms that would have been beneficial to society at large, they crashed the bond market. And they said, the bond market vigilantes are going to bring some fiscal discipline to this market. But they've all been neutralized through quantitative easing. There's bond market vigilantes, then there's quantitative easing. Those two are neutralized. Now we have the gold and silver vigilantes. But they too, now you've brought some gold and silver. This is a gold sovereign from some sovereign somewhere in Europe. I see some eagles flying around with some dragons and whatnot. I don't know what country this might be. Austria?
It's an old Austrian coin.
Oh, see, I can recognize that. See, there's a little gold. How much is this? Almost an ounce. Here we've got 10 ounces of silver. What I love to do with silver is I like to drop it on the floor because it gives people the sense of how actually massive the silver is. I'll do it on this book. You ready for this?
Okay.
This incredible.
Let's see the bounce.
Here we go. Oh! Did you feel it?
Is that like the Japanese stock market bounce?
Well, the Japanese stock market bounce is encouraging people in Asia. Here's my question. The new gold and silver vigilantes are Mrs. Wang over there in China, who's buying gold. Mrs. Watanabe in Japan is buying gold. In other words, people on the street are buying gold and silver because they see the price crash as something to be loved. They love it. They're not being scared out of it. They love it. They buy it. Do they have the power to bring some kind of harmony back to these markets that are so badly stretched out of shape?
You're going to see a push. There's a difference between paper gold, as you've talked about on the show, and we've talked about in the past, paper gold and physical gold. As I told you, I was in New York, and I tried to buy as much physical silver as I could find. And the premiums are higher, and nobody wants to sell the physical product when the price gets too low, because you're getting near points in gold and silver where you're reaching the marginal cost of production. Once you get to those levels, the miners are not going to sell them at a loss like the Fed does. They're going to shut it down. So if it goes below a certain point, obviously it becomes a buy, and buy for the public. It's interesting, however, to note, going back to the Nikkei, not that I want to dwell on it, but when we had a correction, we had a peak-to-trough correction about a week ago where the market declined 10% in 4 hours. And I didn't see that. I mean, that's major financial news, and I didn't see that on the head of any broadsheets anywhere or actually covered too much by the...
Well, these flash crashes now have become normalized. Back in the day when I was on Wall Street, if you had a crash like that, it would be news. The news cycle would have picked it up and talked about it. But now it's been completely normalized. People just know that most of the trading is done by computers, for computers, by computers, for the benefit of computers, and that these huge gaps in the marketplace are just to be normalized, of course, until the day where you have a 50% gap in the price of gold that's now trading at $6,000 an ounce. Talking about these price estimates, Societe Generale's Albert Edwards sees $10,000 gold due to this quantitative easing. Is that where we're heading?
I think we can absolutely see $5,000 or $10,000 gold. I think that the United States has blown its role as a leader in the currency world, because basically the value of the dollar since the Fed came around in 1913 in adjusted terms has declined by about 97%. So the reserve currency status will eventually fade, but that's going to take a bit of time for that to happen. I think that there's a lot of optimism bias in every market that we see, especially like London real estate.
Okay, let me jump in there, because when you mention London real estate, you think about this new Help to Buy scheme, you think about George Osborne, and of course when you say George Osborne, you also think Ponzi scheme. As a matter of fact, when you look up Ponzi scheme now in the dictionary, you see a picture of George Osborne. So tell us about George Osborne's Ponzi scheme and his Help to Buy scheme. Well, it is a Ponzi scheme. It's one of the biggest Ponzi schemes I've ever heard of, and it's amazing. The IMF is against it. Mervyn King was against it. I'm against it. I don't know what your position is on it. But the taxpayer, this is speculative gambling by central bank intervention and governments with taxpayer money yet once again. This is Fannie and Freddie Mae. This is not only similar, it's much worse, because there's... And these are the two that went bust,
right,
and it was a subprime mortgage that caused the whole price to begin with. George Osborne is seeing that. He wants to mimic it.
Right, except on a much larger scale. So what they're doing is providing part of the down payment, and they're backstopping any mortgage provider for 80% of the mortgages, which is crazy, with no set-asides.
Yeah, but in
that's
this
a
country,
recipe for disaster in a market that's already overpriced. Because the historic norm in any real estate market globally has been 3 times income. And there are pockets of London now that are trading at 40 times income or 50 times income. Now, the tax structure is different here than in Monaco, so I can understand why somebody would want to be in Monaco. London's a great place, so you can't compare apples and oranges.
All right, well, Mitch, we have to cut it off there. We're out of time. But thanks again for being on the Keiser Report.
Thanks again, Max. Thanks for having me.
All right, and that's all the time we have for this episode of the Keiser Report with me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Mitch Farstein. If you'd like to send us an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.